So if we wanted to do this, literally, they could say, hey, make it 40,000 bucks. Gold's 40,000 bucks an ounce, physical only. There's $10 trillion into the TGA, and they are going to spend it immediately on whatever, infrastructure, reshoring, something productive, hopefully. But that's the type of thing where, again, it's the exact what Chris Cole's talking about is that gold is worth 40,000 now. You can see the debt, right? We know at some point that debt has to get written down, likely against gold. We know what the debt's doing. We know the debt's unrepayable. And so at that point, it's just, Americans won't buy something that's not going up in price culturally. And if gold's just sitting there, we won't own it. We won't be patient. We mark our assets to market monthly. But the fiscal situation for the U.S., for the world, for Western sovereigns, for China, all of it are getting worse and worse and worse and worse and worse. You see all these central bankers buying all this gold. You see the world's biggest oil producer and energy producer buying gold in Russia. You see the U.S. having a fallout with Saudi. All the signs are there. I mean, so it's, if you came to me and said, Luke, it is, next Monday, gold's $40,000 an ounce. I'd be like, I knew it was going to happen someday. I didn't know then. Now, if we go 10 years from now and gold is still friggin' 1,800 bucks, maybe 10 years I'd be a little surprised. But at 5 years from now, if gold's still 18 and they've 1,800 and they've managed to muddle this thing along for another 5 years, which I think is a stretch, but in theory, that wouldn't surprise me either. So it's
but then it doesn't go to 5,000 overnight. It goes to 10,000 overnight,
right?
Or just to whatever level.
Yeah. That's right. Yeah, because the underlying stress is still rising. That volatility is being transmuted, and it's going to keep being transmuted until it stops being transmuted. And we're all going to know when it stops. Go home on a Friday, it's 1,800. You come in on Sunday night and it's 5,000, and you were either there or you won't. And by the way, it's physical only. If you own paper claims, you're going to get cash settled at the Friday 1,800. And if you didn't own physical, sorry, that you always knew the name of you always knew the market. If you didn't know the market, you should have known the market. That's your fault, not theirs. So I increasingly think the lack of movement in gold, particularly when everything else has moved the way it has, to me, my conclusion, it actually makes me feel, it doesn't make me feel good, but it makes me feel increasingly confident that gold is likely to resolve on the upside in some sort of reset in a very compressed time frame.
All right, so if you want to know more about why Luke thinks that gold has been suppressed and is the price that it is now, and more about his thesis that there is going to be a reset and gold is going to be repriced, like Jim Rickards says, then I'll put a link in the description below. Watch the full video, the full interview with George Gammon and Luke Gromen. Fantastic video. I highly recommend it. But what I'm going to do now is I'm going to share my reasons why I believe that gold hasn't yet made that next move up, and why I think that is a false claim and will be proven to be incorrect. Whether this reset happens or not in gold, I believe, and I'll show you in this video, why I believe that we are going to see higher gold prices and therefore higher silver prices. And also towards the end of the video, I will share more about my thinking about when I sell my gold and silver, or at least my silver anyway. In my opinion, this is the reason right here why we haven't seen gold make that next move up, and that is because 69% of investors think that inflation is transitory, according to the Bank of America Global Fund Manager survey. And honestly, this has been my opinion for some time as to why gold hasn't yet had that next move up, is because a large percentage of people think that inflation is transitory. So people are sitting in cash, are sitting in bonds, are taking, putting their liquidity into, growth and speculative assets, whether that's stocks or crypto or whatever. But as you know, my opinion on inflation, we do have inflation. It is here, it is sticky, and it's going to be around for many, many years to come. And let's just have a look at that. So these were the CPI numbers that came out, 5.25%, and it was slightly less growth than July. Okay, so we still got CPI. It's still, high. It's just the rate has dropped down from July. And so the deflationists have come out and gone, bingo, CPI's peaked. We're now heading into deflation. Yeah, hold your horses there, folks. So you can see here the CPI, just another chart. Yeah, it's rearing its ugly head, isn't it? Now, why we believe that this is just a little blip is we think that the lower rate of CPI was due to the commodity index going down in August. However, you can see that since then she's back up again. So we're thinking the next CPI numbers are going to come back out higher. And not just us, Jeff Gunlock, the real bond king, billionaire bond king. When you actually replace shelter with HPA, when you actually look at accommodation or real estate in real terms, not the stupid measures that they use, then Jeff is saying that inflation or CPI is really at 12%, not 5.3. Shadow Stats shows this. A whole bunch of people are saying the same thing, that inflation or CPI is really double digits already, 12, 13%. So you got the real bond king here, who's really telling the truth. So this is, according to the bond king, this is the highest CPI we've had since the 1970s. But the market, investors, are believing the Fed at this point, and even people at the Fed are starting not to believe their own BS. And this is the point, is when we look at the 1940s, the CPI during the 1940s, CPI didn't go up in a straight line. This is what annoys me with the deflationists, is any little sign of a lower rate in CPI, it's, deflation. It's not deflation. Wake up. You can see here that in the 1940s, we had these inflation or CPI spikes. Okay, but what does that mean? Well, from 1940 to 1952, CPI increased 90% to a permanently higher plateau. It is the devaluation of your currency. Oh boy. 1970s. Look at that at the bottom there. You can see once again. Did CPI go up in a straight line? We talk about stagflation in the 1970s. No one talks about the 1940s. Yet, actually, if you have a look at the chart above, Lynn Alden talks about this, where interest rates were pretty much held to the floor, and we saw these big spikes in CPI. And look, Lynn argues that we're more in the 1940s. So when we look at the debt to GDP and that situation, the balance sheet, people talking about how the Fed can't taper, the Fed can't allow rates to rise, so that all makes sense. And so Lynn's thesis that we could be looking at 1940s style of interest rates and CPI, she may well be right. And have a look at some of those spikes. We had almost 20% in 1946 CPI. That's nasty. So that could be right. But look at the chart in 1970s. Once again, didn't go up in a straight line. CPI goes up, comes down, goes up, comes down, goes up, comes down. The rate of change was still positive. CPI kept going up and up and up. And throughout the decade, by the end of the decade, from what you started with, if you started with savings, by the end of the decade, you're very, very poor. Okay, now, there's some out there saying that we're about to see hyperinflation. And look, maybe we are. I've got some friends who are from, Serbia, Bosnia, that the old Yugoslavia, Croatia, And they talked to me about experienced hyperinflation in the early 90s, late 80s, early 90s, whatever it was. And they tell me stories, and they've still got currency to show what the currency looked like. And for me, I can't get my head around that. I don't know what that's like to live in a hyperinflationary environment. Who knows? Maybe we find out soon. I don't know. But this whole CPI thing, people, you got to understand, CPI doesn't go up in a straight line, and we're going to have ups, we're going to have down. We're going to have these spikes of CPI. Doesn't mean we're about to go into deflation, folks. And so, as I said, this is the reason why I believe that gold has not yet pushed through its all-time high like it did in August last year, and continue going forward, because people have bought into the transitory talk. However, people are going to find out that actually we're wrong on this, that we do have persistent inflation, and so when more and more people actually wake up to the fact that their savings, their currency, the yields on their T-bills and notes and bonds are getting absolutely trashed, we're going to see a flood of that currency come into the precious metals to get a little bit of saving. It's like when the rain is pouring, everyone starts rushing to some shelter to get out of the rain, to get out of the storm. And this inflationary storm is here, yet people think that it's just a passing shower. And look, Germany's got the same issue as well. Their wholesale price is the highest it's been since the 1970s. So it's not just a US issue. This is a global issue now. When you have governments increasing deficit spending, when you've got central banks basically monetizing that, whether through the shell game of the dealer banks or not, whatever, doesn't matter. There is more currency, more M2, more bank deposits being created, more currency being created at the same time that we've shut down the economy over the last 18 months. So we have less production, less supply of goods, and more currency. Pretty basic. Where that continues, I believe it will. If we had a free market, I admit, if we had a free market, we would be seeing massive deflation. But we don't have a free market. We've got government intervention. We've got production being hammered. And yes, some of those supply chains will improve as time goes on. However, we have completely scarred the economy and scarred that supply side of the economy. And I don't see any slowdown from government deficit spending. So we have seen in some sections bank lending contract. However, governments have not only covered the difference, they've actually increased it. And you can call that MMT light, whatever. But that seems to be the way we're moving. And when we get central bank digital currencies, and they're coming, I mean, we've got MMT, full MMT, and good luck. In my opinion, that's where you don't own gold. It might be a bit hard to get hold of, and silver as well. Just a reminder, my friend, debt is the very essence of fiat. As debt defaults, fiat is destroyed. This is where all these deflationists get their direction, not seeing that hyperinflation is the process of saving debt at all costs, even buying it outright for cash. What are the central banks and governments doing at the moment? Deflation is impossible in today's dollar terms because policy will allow the printing of cash, if necessary, to cover every last bit of debt and dumping it on your front lawn. Worthless dollars, of course, but no deflation in dollar terms. And this is what I believe central banks and governments around the world have shown their hand, in particular in the last 18 months. They have shown that they will not allow deflation, that they will not allow debts to default and for mass bankruptcies, that they will save this debt bubble by buying it outright, by printing, not physically printing, but digitally printing. And of course, then they're like, here you go, here's your dollars, here's your currency. So having a look at gold now, and this is, some people, forget to remember that in the 1970s, especially in 1975, the gold actually went down. Gold went down. So in that 1970s bull market, it was broken up in 1975 where gold almost fell 40%, as you can see in this chart. So this chart is a percentage change from the year before. Okay, so it looks like it's had a massive big fall from 1974 down, but that's just the rate of change from the year before. And from 1976 we just had that bull market in gold and silver, and in particular in 1978-79 when really people were worried that the US dollar was about to collapse, and Jimmy Carter issued those Carter bonds. I've done a video on that before. Because people were losing faith in the US dollar, in its purchasing power, and so you saw gold and silver almost go vertical, and then eventually CPI and inflation was kind of hosed out, and obviously gold and silver had that quite a big fall from there. But yeah, people keep forgetting that gold actually did fall quite a little bit in that period. And so where are we in this bull market right now? Well, in this chart, I like this chart. So this is a non-inflation adjusted chart, and you can see 1971. You can see that the bull market in gold, if you want to talk, say it that way. And then you had that 1975 period where gold did come back a little bit, and then the rest of that bull market up to 1980. And then from 1980 to 2001, gold did not perform well for quite a period, and it was a great time, in particular for stocks and bonds. But then from 2001 through to 2011, we had that awesome bull market, which I caught the back end of that, which I was very happy, and then got a bit lucky where I then converted my silver into US property. So I was quite lucky. It wasn't great brains on my behalf. I definitely know that some timing and a few things fell my way to make that work. But then from 2011, gold and silver didn't perform well. But in about 2016, we've seen that what I believe is the beginning of a new bull market in gold. And if we know that gold, these bull markets usually last, between 8 to 10 years, we're only halfway through this bull market. So, whether there's a reset of gold where we do see, $10, $20, $30, $40, $50,000 gold being reset against the debt that governments and central banks have built up, I still think that we're in the middle of a bull market in gold and silver. How high? And remember, it's always that last part of the bull market where you really get the big exponential gains. And in my opinion, silver in that back end performs better than gold. So, as you know, guys, I've got a price target on silver personally of triple digits. I do believe that we are going to break the all-time high of silver, and that we are going to see triple digits in this bull market. Now, if we have some kind of reset, which is a possibility, then obviously it's going to be reset against gold. But the relationship with silver will mean that silver adjusts somewhat to what price level, I got no idea. But even putting that to a side, let's say that doesn't happen, which is also a possibility or probability. just in a normal bull market with what's going on and the inflation that I believe that we're going to see, and when people realize that there is an inflationary storm and they want to go get that cover and get under cover, then we're going to see that surge in gold and silver, and I think silver will hit triple digits. And so people ask, when am I going to sell? Well, it's kind of based on this, but also some other factors, which we'll come to in a sec. So for my Aussies out here, so this is central bank government bond holdings. Now, I've shared in other videos that the RBA, with their $5 billion a week in quantitative easing in bond purchases, are actually buying more bonds than on issuance than Greece. And you can see Australia's come off a very, very low level, but we are tracking to increase the percentage of bonds held by the RBA. The problem is, though, when you look at the US, Japan, UK, Europe, so the demand for Aussie dollars and the demand for Australian bonds isn't nowhere near comparable to US dollars and US treasuries and euro and the pound and the yen. Okay, so there's more demand for those other debt instruments, government debt instruments, and dollars from international investors than there are with Australian debt. And if I'm wrong and we have a risk off, because the Aussie dollar is a risk on, a risk off currency, meaning when people are out there just investing in growth and speculative type assets, then the Aussie dollar does well. But when everyone's fearful, they generally run to the US dollar, and the Aussie dollar gets sold off really hard. And we saw that in March last year, where the Aussie fell down to, what was it, about 56 cents. But this also potentially could be inflationary for Australia. And I say potentially because there's a few nuances there. So when we look at the household debt, we've now ticked over $3 trillion here in Australia. Now our economy, our GDP is about 1.6 trillion. So we're pushing pretty close to 150% household debt to GDP, which is high, and that is why we've seen so much support to the housing sector, from both government and the RBA. And when we look at the Australian median house price versus the US median house price, in the US they're talking about a housing bubble. Housing in the US is a lot cheaper than it is here in Australia. We've got Australian median houses 10.5 times the median income. In the US, it's 5.8 times. So, yeah, we've got very, very expensive real estate, measured in whether it's debt to income or debt to GDP or whatever. And so, in fact, our Reserve Bank said that for every 1% rate cut, it increases property prices by 30%. So there's a lot of pressure on the RBA to keep interest rates to the floor as well, because we as a country cannot afford higher interest rates, both now, I believe, from a government point of view, but also a household point of view, especially a household point of view. And that makes up a huge part of our economy. We basically are two things. We dig stuff out of the ground, ship it overseas, and housing. That's the Australian economy right there. And so people say, well, Steve, why are you buying gold and silver? When are you going to sell it? Well, I look at gold and silver and I measure it not in terms of dollars, but in terms of other assets. Okay. And you can see in 1980, it took 100 ounces of gold to buy a Sydney house. And in 1986, 87, it was 150 ounces. Today, it's about 550 ounces. At the peak in the early part of the 2000s, you can see that it got over 1,100 ounces. So that's when you probably wanted to sell real estate and buy your gold and then convert it. So wealth cycles. And I've done a video on this where it worked for me from 2008 to 2012, that period where I went and bought silver, sold silver, converted into real estate and so forth. And so could this Sydney house price to gold ratio get back to 100 ounces of gold? Absolutely. Absolutely. So I'm expecting both gold and silver to do extremely well, to go up a lot more. And I actually would not be surprised if we see our first housing crash in Australia. And Australians think that can't happen because, you know, we haven't seen one. Or we haven't seen a big one anyway for a long time. So, yeah, I see nominally house prices can fall over the coming years. At the same time, gold and silver go up. Could we see 100 ounces of gold to buy a Sydney home? Probably. I guess time will tell. But I definitely think that even at these prices, gold and especially silver is cheap in comparison to definitely the stock market, definitely the bond market, and I would argue also the real estate market. So, you know, are we going to see a reset of gold? Well, we're seeing central banks around the world buying gold. Apparently, our own Reserve Bank of Australia is now buying gold as well. You know, is this you know, getting the ducks in order for some type of reset? There's talk that the digital yuan is going to be backed by gold or some sort of backing by gold. You know, if that does happen, then you'll want, in my opinion, you'd want to have some gold in your investment portfolio. You'd want some silver in your investment portfolio for that scenario. If that scenario doesn't play out and we're wrong about that, I still think we're in a bull market because I think the macro environment, inflationary environment, the debt environment bodes well for gold. I think that there's going to be a lot of volatility moving forward in the years ahead in asset prices in particular. And once again, I think gold is something that you'd want to have in your portfolio. But, you know, that's just my opinion. That's not financial advice. Anyway, guys, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like the video, please hit that like button. We really do appreciate it. If you haven't subscribed, do so. Hit that notification bell. Anyway, guys, take care, and I'll see you again on another episode of Finance Uncut.